talking about the concept of support and resistance. And regardless whether you're doing CFD or Forex trading, whether you're trading oil or gold, whether you're trading in short-term day trades or you're trading long-term, or you're even looking to invest in longer-term investments, you need to understand these levels of support and resistance. Now, in tonight's class, I'm going to use the term security, but I might also use the term stocks or cryptocurrency, or I might say Bitcoin, or I might say Forex, or I might say CFDs. In fact, when I say these, I'm not specifically applying it to a particular asset or class. What we're talking about tonight will hold true for any publicly traded financial instrument in which there's an open market. Also, I will intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and techniques presented in this class are equally adept. It just gets very boring saying trading, 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 or security, security, security. So I just try to make it a little bit fresh. Now, all of us want to answer one great big question. Should I buy today? What will the prices be tomorrow, next week, next year, maybe even just 1 hour from now? Would investing be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball, and I don't have a Ouija board. So alas, if you're attending this class in the hopes that technical analysis has the answers to these questions, I'm afraid I have to disappoint you. It doesn't. Nobody does. However, if you're attending this webinar with the hopes that technical analysis and the concept of support and resistance will improve your investing and trading, I have good news for you. It sure will. Now, trading, or the concept of support and resistance, is like understanding how an elevator moves in a building. Support is the area below your feet that's holding you up. Resistance is the level that you have to break through to reach the next level. And when you break through that ceiling in the elevator, the ceiling becomes the floor under your feet. And the next ceiling becomes your level as your resistance level. And I use the elevator example because it's the same thing whether an elevator is moving up or moving down. And the market's price can move up or down. But the thing about support and resistance is once you do some evaluation, you can determine these levels and how important these individual levels are. Because they're not like floors 1, 2, 3, 4, and 5. You know, price moves. The euro could be a 117.31, 117.32. So it's just like an elevator where it's floor 17, floor 417.2, floor. But if you imagine a building with an elevator, and say it's a big high-rise building. Okay, it's a mixed-use building. I'm just making this up as we go, but it's a mixed-use building. It's got condominiums on the top floor. It's got an observation deck all the way up top. It's got a smoking deck up there. And of course, it's got a big, expensive restaurant somewhere up there. In one of the middle floors, it's got a nice restaurant that, or cafeteria style restaurant that mostly the employees in the building use, but it's open to the public. Another floor has conference rooms and meeting rooms. And then lots of other floors might be a whole floor that's just a law office. And down below, there's small offices with some accountants, some lawyers, some dentists. If you were to observe how these elevators move up and down and where they stop and where they go from where they stop and the time of day, you could actually make some evaluations, make some determinations, and come up with some probabilities of where that elevator might go. Okay, so for instance, it's 7 o'clock in the morning, so most employees aren't coming to work. So if the elevator starts going up and it's kind of empty, there's a good chance it's going to go up to the roof and pick up some smokers that were working in the building that went up to the roof and smoked. If it's 11 o'clock at night, there's a good chance those elevators going up to that swanky restaurant up on the roof. So it's not going to stop at those intermediary floors, and it's very slim chances to stop at, those individual offices. Maybe they'll stop at that cafeteria office, but we can do some evaluation. So support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have their own idea on how you measure support and resistance. Now, the concept of support and resistance form the basis of technical analysis. Forex traders look to buy at or near areas of significant levels of potential support in an uptrend, or significant levels of resistance in a downtrend. Now, for instance, gold, I believe, broke $1,300 an ounce yesterday or day before. Gold's been trading much higher. Gold was staying at 12. It was down to 1,200 level and moved up to 1,250. Now, we knew $1,300 was a significantly important level. And most of the time when gold was pushing up to that level, it couldn't break through there. So what did 1,300 to gold traders? It was a significant resistance level, because every time gold got close to it, it bounced off and came back down. So you may have heard the old business cliche, buy low and sell high. New Forex traders usually ask the question of how low is low and how high is high. One way we can quantify these levels is using areas where prices stopped and changed direction. So that's one way. When prices moved up, hit a number and bounced off of it. Another way is to see where there's congestion, where the traders all got together and seemed you had lots of trading coming up, bouncing off this price, but not making anywhere. Now, it might have gone right through, and there could have been times that it went straight through that price, and when it came back down below that price, it had a lot of reaction. It's a price that held some historic significant importance to the traders. And the thing about support and resistance, it's not based on where the price is, it's based on where the price is today, but your support and resistance levels come from the past. So, for instance, when Bitcoin soared all the way up to $20,000 or $19,000 last year, it didn't have any historic. So there was nowhere back in the past to see how price would go. When price fell all the way back down over time, and now it's down to $3,000, $4,000 range, we can compare what prices in that range were important, say 2 years ago when Bitcoin was at that price, and see what exact levels were crucially important to traders. Now, resistance and support are the exact opposite. Remember, it's the floor and the ceiling. Support is what holds up the floor. Resistance is what stops the floor from moving up. Now, there's no law, there's no rule that price can't soar right through any of these. Okay? Doesn't even need to stop. But the fact is that price doesn't go like that. Price goes like this, this goes, and it makes peaks and troughs, tops and valleys. Buyers and sellers hem and haw. Okay, and so it usually doesn't go right through a resistance level. What it does is it will move up towards that resistance level and might touch it, bounce off it, touch it, bounce. And the resistance level doesn't mean price is going to reverse and fall. Doesn't mean that. It has nothing to do with saying the trend is over. Now, if you understand how a trend works and price movement, you'd understand that price, a well-constructed trend, is exactly what you see. Price is moving up, making a higher high, then easing back down to make a lower high, then pushing back up to make a higher high, easing back down, because what happens is traders buy in the market. It takes a lot of energy to push that price up. At some point, some of these traders get tired and move out of the market. Then you have others who say the price is getting a wee bit too high, so I'm not going to buy now. So they just move over to the sidelines. And then you have others who bought down here who say they already put their take profit point here. They were already made their 50 pips or their 20 pips, and they're selling because they already made their predetermined target price, and they're selling. So what happens is price then eases back down. At some point, price eases down, and these buyers who move to the sideline say, I'm going to get back in the market. These buyers that were tired out say, I got another wind again. They're going to move in the market. The sellers who were selling at that price already, they're already out of the market. And so the market starts moving back up, and it's going to hit a point and it's going to retrace. These retracements form these resistance levels. So when we can look and see when the euro was trading at 113 last year and is back at 113 again this year, we can look and see what these levels were where these traders either jump back into market or where these traders were coming out of the market. And we can determine those, and we can then apply them to today's movement around that same price. So then you also have another group of people who bought at the wrong price and are hoping the price will recover so they can just jump out of the markets. They were trading in the wrong direction. So here we see an example of the pound. This is an old chart, but we can see a beautiful example here. We came off of a downtrend. Prices recovered and moving back to an uptrend. It moved all the way down to support and bounced back off and moved up to see it broke right through this resistance level and went right to this resistance level, fell back down and found a new support level, went back up and went to this resistance level and formed this support level. Now, these are not one-time shots. These can be extended out into the future, and they stay valid forever. So whatever the asset is trading back around these prices again, these lines of support and resistance become significant. They have no significance when prices move way past them in the other way. But also when you're buying or selling in the marketplace and you need to set your target points and your stop losses, these would also be important because you want to see where price would ease back down to or move back up to when it is around where you're entering and exiting it, so that you know how to set your stop losses and take profits. So one thing to remember is that support and resistance levels are not exact numbers. Oftentimes you will see support and resistance level that appear broken, but soon after find that the market was just testing it. With candlestick charts, these tests in support and resistance are usually displayed by candlestick shadows. Shadows are the wicks of a candlestick. So we can see here, we have a support level that was drawn on this chart and extended forward. Now we see price coming down, it comes to the support level. We don't ever see the body of that candle break the support level. What we see are the little wicks, which is just the lows of that trading period, breaking below with the bodies of the candle staying above. So what it was doing, it was testing that support level. It found that support, moved back up, came right back down to that support level later, and did the same thing, and then continued back up. So what it was doing is starting to form an uptrend. So support and resistance is common jargon for areas on a chart where price has a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like the price ceiling that the price cannot break above. And cannot sounds like a very definitive. Price can do whatever it wants to do. All we're trying to do is interpret or estimate or come up with a reason to use these. That doesn't mean that something's not going to happen. The price is going to fall right through the resistance level or right through that support level. There is no law that stops price there. But when you're trying to evaluate the markets, you need to have something. So knowing where these levels are make it much easier to decide when to open and close trades. Okay. And we're going to talk about how you locate those on charts. But let me take you over to a live chart so you kind of understand what we're looking at. Now, also, tonight, if you notice on your screen, there are two handouts I've set up for you. One is called Support and Resistance Indicator Explain. Okay, this is a more precise explanation of tonight's class with exact charts and everything else. If you click on it and download it, because the only way to get it is in this live class. There's no other way to get this. And also, I've given you a full guide on Introduction to Technical Analysis, and that's going to explain to you and show you several other ways to get support and resistance, like using Fibonacci levels and Gann fans. And there's many ways that you can get these. Tonight, we're going to be looking at the three primary ones, which are what I call eyeballing. Then we can also have pivot points. Okay, and we have swing highs and swing lows. But now we're looking at a live chart for the Euro US dollar. Now, when I had set up this chart a while back, I drew my support and resistance levels on this chart around the price and where the price had been trading at that time. Now, we had a beautiful downtrend going on at this point. And at this point, we got the first test of this downtrend, and then we had a breakthrough below. And then price moved back above the trend, and we would be looking for it at this point to either decide it's going to continue down here, but it didn't, it reversed back up. So we're looking for it to continue to end this downtrend and move into an uptrend. We waited for that price to come to this, which is now a resistance zone, which had earlier been a support level. But look at when price was moving down, how important this level was, how many times price had touched this level. Okay. Here, 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 here. We had all of these different prices, and this level was brought from way back here from the last time the euro was trading at 113.608. Okay. So we've now got our what was at this point a support level, now as price was moving up was a resistance level. Okay. When we saw it approach this level, we're looking at this point, if it breaks that level, we're going to buy. We saw it break that level and we would have bought, and we would have estimated our target price to be the next resistance level, which was already set up here at 114.169. As you see, price steadily moved up to here. It got slight congestion here. We would have entered the market here and exited the market here, and we would have been out of the market. Now, I've left this here for it to continue forward so you can see how it's progressed since then. So as you can see, price moved above this resistance line, but came right back down to it, pushed back up, and came back to it again. Now, something's happened today, and I think it's probably the Fed. I don't know what the Feds did in the U.S. just recently, but this is a very unique volatility candle. But you see all the times that this resistance level or support level was intricately important at this price. So let's go back to my PowerPoint. So one of the great ways to find support and resistance is to mark levels in the past where price had a difficult time breaking through. As price moves up and down, each level that price has bounced off of could be a level in the future that price bounces off again. Now, this is a manually intensive method, but it takes time to draw on all pairs that you're trading or assets you're trading. It's one of the reasons we limit the amount of assets we would trade, but it can pay off in the long run. To me, what I call eyeballing is the most important because it makes you interconnect with your charts and interconnect with price action. You know, today's charts allow you just to drop everything on with a click of a button. And I find that what happens is you get disassociated from price. You start trading from all of these important lines and indicators on your chart, but never interacting with the actual true price that's on your chart. Where when you do this by hand, it causes you to work directly with price action, and you and your charts and your asset become a lot more interrelated. Now, I've got a presentation set up for you that I'm going to share with you. It's going to show you step by step how to set this up on your charts and how you would go about drawing these lines of support and resistance and keeping them forward. And you'll see that it is time consuming, but once you have a particular asset set up, you don't have to do it again. Okay. So let me share this presentation with you. And hopefully this will explain everything. Well, I know it will. And like I said, it's a step-by-step process it's going to show. Now, it's important to remember that you should start out with a longer time frame, whether it's a 1 week, 1 day, and draw in your support and resistance levels like you saw us do on the chart. Okay. Then you would use those support and resistance, or we could call those major support and resistance levels. Then as you close in at a smaller time period, you would use the same chart. You wouldn't erase those. As you would change from a 1 day chart to say a 4-hour chart, you would then isolate more precise or alternative support and resistance levels. So if you would use the longer period as your major support resistance levels, those are what you would use to determine whether you would buy or sell a position. And then say if you're trading in CFDs for a very short term, within 1 day, and you want to find an entry point within 15 minutes, you would then draw your support and resistance for around the current price using the shorter time period, because you would use those to come up with your entry and exit points. And you'll find that this works extremely well to give you information, because remember, these support and resistance are not precise exact numbers, and the more you try to make them exact, the less successful you'll be at. Remember, these are just zones, because there was no science used them. They were observation, where you had observed in the past where the traders had made highs or lows or congested. Now, we showed you or mentioned some other ways. Now, arguably, the easiest support and resistance levels to add to our charts are pivot points. Now, pivot points will give you a different levels of support and resistance. These pivot points come from mathematical calculations that use the high, the low, and the close, but they're constantly being recalculated as price moves. And in most pivot point charts, now there's something called a pivot point calculator, which you can get, it's free, and you have to quickly drop in these numbers and do some calculations, and it'll give you the 3 levels above and 3 levels below your price, or almost every place you go that has financial technical analysis on its site, like investing.com, also will have a pivot point and a calculator as well as a pivot point chart. So we only want to use the classic. Okay. These are other types of trading indicators down below, which are perfectly fine, but you'd have to be using those indicators. But as you can see, it's going to give us 3 levels of support underneath that current asset, and it's also going to give us the next 3 resistance levels. But these have to be calculated based on the time frame you're looking at, and they're constantly being recalculated. So they're only good at the time you get them, because that's why they're dynamic. They're constantly changing. But they will help isolate good entry and exit points for you, and where you should be making or watching a price move while you've got your short-term trade in effect. Now, remember, the market ebbs and flows. They go up, they come down, they move sideways. The primary way we make sense of these movements are analyzing the price action as well as the level in the markets where price bounced higher or rotated lower. And we call these levels of support and resistance. Support and resistance levels form the foundations of technical analysis, and they help us build a framework from which we can start to understand the markets. Now, regardless of how you want to trade, regardless of what strategy you want to use, regardless of what you're going to do, there are basics every trader should be using at all times. They should be able to look at a chart and understand what price action is. Should be able to draw a trend line to see what the markets are trying to tell you, what the speed and the movement of that current price movement is, and is it a trending, and be able to put on the applicable support and resistance zones. Okay. Whether you're going to do anything else in your chart, whether you're going to add indicators or how you're going to trade it, whether you're going to trade for, that's up to you. But these are the basic foundations that every trader should have and be using them in their trading every day. Because even if you're going to be a fundamental trader and trading just because Apple had some headline about, they're lowering prices and sales are going through the roof, something's going to have to tell you how that market is reacting. And that's on your charts. And then as that price moves up, are the traders going to keep pushing it up, or are they getting, bouncing back off? That's from your support and resistance levels. For price action traders, support and resistance levels help us plan our stop loss placement, our profit targets, and perhaps more importantly, these levels give us a way to make sense of the market in terms of what it has done in the past, what it is doing now in the present, and what it might do moving forward. Now, we can also combine our swing points and our support and resistance and our swing point levels and use these in our trend identification and our trend interpretation. And I'm going to share another presentation with you, which will show you how to use these all together to make some trading decisions and how to set your stop loss and take profit points. So we mentioned here Fibonacci retracements. Now we have whole classes on Fibonacci retracements, and it is an indicator to itself, but these retracement levels also serve as levels of support and resistance. But one of the most strategic support levels that you can draw on is known as a retracement level. It's got nothing to do with Fibonacci. It actually comes from Charles Dow and Dow theory. And that's the belief that each up movement will retrace itself 50% in the opposite direction. Okay. And it's the halfway mark of a move. So when a prices move from, say, 1200, gold's move from 1250 to 1300, it's probably going to ease back down to 1275. Okay, so that was half of the previous move, and then move back up. Okay, and this is a partly self-fulfilling event and partly just as a result of normal market dynamics. Now, you can learn how to trade with these 50% retracement levels, and you can see on the chart that I just popped up here, you can measure the previous move and then calculate 50% of that previous move and then use that as a resistance level, a support level, and add that into your trading. Okay, because 50% tends to be very popular. If you want to use the Fibonacci's and use the 38.2 and the 26, the 23.6 and the 75, that's perfectly fine also, and use that from the Fibonacci retracement tool, and those are Fibonacci ratios. But there's many different ways that you can calculate these support and resistance levels. But now that you know the basics, it's time to apply the basics, but extremely useful technical tools in your trading. We want to make things easy to understand, so we've divided how to trade these in support and resistance levels into two simple areas, the bounce and the break. Okay, so the bounce is when price bounces off of a resistance level, and the break is when it breaks through a resistance level. And I'm sharing with you a little PowerPoint presentation I've arranged for you. Now, the step-by-step process is on the actual charts that you're going to see. There's no voice explaining to you because it's very, very short. It's also in that handout I gave you tonight, okay, explaining each one of these steps of how you would use support and resistance in your actual trading. But just look at follow along the steps that are shown under the chart for each one of these slides that I pop up on your screen. So I'm going to replay this for you again so you can watch it a second time. So as I said before we watch that, all of those charts and the step-by-step processes in that handout I gave you under the support and resistance indicator explanation handout guide that you can download from your screen right now. Now, we have gone over the major types of support and resistance and how I use them as indications of market conditions, whether market's trending or range bound, levels to look at the buy or sell from, Levels define risk and as a framework to understand what the market has done, what it is doing, and where it might go next. When you combine a solid understanding of support and resistance levels with price action and market trends, you have the triumvirate of trading. You can't ask for any more than that. Support and resistance doesn't have to be confusing. We can mix and match any of the methods above to create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure to test out these methods using a real-time demo account, especially the one on Alvexo. You can set one up now by going to www.alvexo.com and try out the support and resistance. And on their charts and most charts, you can go up and click on pivot points, and they'll automatically drop the pivot points and keep them updated on your charts. So that's one that you can have all the time without doing any work. Now, also the presentations that I've given you to share with you tonight, you can find by looking, by going to YouTube and looking for Forex and CFD education, or I've put the link on the bottom of your screen here, and locate them under support and resistance in the playlist. So go look for Forex and I believe it with an ampersand. Forex and CFD education is the name of the YouTube site where you can see these these little videos I prepared for you that presentations we've done in the middle of class tonight. So thank you very much for joining us, and hopefully you've learned a little bit about support and resistance tonight. Have a good night, and thank you for being part of Alvexo and investing.com.